Hey everyone, Dan here. I wanted to take a look at trading strategy using moving averages today. Uh, if you enjoy these videos, please hit the like and subscribe button. It helps a lot. And let's get right into it. So moving averages, if you look up here, you'll see MA. You see MA 5, 12, 50, and 180, and the corresponding colors. And then you'll see lines that are those colors on the actual chart. So what that is MA5 is accounting for the average price over a 5-day period. The MA12 is average price over a 12-day period, so on and so forth. So the reason that we have several different moving average indicator lines is so that we can sort of play different strategies. So let me explain this a little bit. So if you see the green line, it's following the price action the closest. It moves up and down very quickly based on the price action. That's because it's the shortest time frame, so it's the most sensitive to any changes. So it's only accounting for a few days of price activity, and therefore any change in the price right now is has a very big sway on the overall average of the prices from that 5-day time frame. As you get a lengthier time frame, 12, 50, and 180, for example, you see they move more slowly. And that's because they are less sensitive to the price action at the moment because they're taking into account many more days of price activity. And so what's happening at the moment isn't as impactful in the vast scheme of all of the days that it's taking into consideration. So let me explain to you why we use these different averages and why you might have more than one line on your chart at any given time. So the reason that I have all these four right now is actually just to show you the different ones. I wouldn't actually uncover a trading plan with 4 lines on my chart. It would just be way too busy. There'd be too much going on. So let's make an adjustment here. I would typically have 2 that I would be looking at. And one would be so that I could plot an entry point, and the other would be so that I could plot an exit point. And so for a more aggressive strategy, what I would potentially look at doing is do something like, take an entry as the price breaks above the MA5, and then set my cut loss as the price dips below the MA12. So let me show you what that would look like. So if you see that here, so the way that this would have played out if we had set the indicators just as I did, and we would have played that here. So I would have been looking to take a position as any of these candlesticks broke above the green SMA. So if we look at the first one that really establishes above it, that's this one right here. Okay, let's just make a little drawing there so we can make sure everyone is looking at the same thing. So this one established price above the green moving average, and then it had sort of like a bunch of ups and downs. It didn't, although this red one was close, it didn't break below it and hold. As you can see, it's still poking its head up above the green. And that happens all the way up through here. And so here we're riding this this trade. We're feeling really good about it. Things start to flatten out here, a bunch of double and triple tops, and then it starts to break lower. And then here's the first one where the price holds below the orange moving average, which was my 12-day, and would give me an exit point there. So I took the entry point on the more, say, sensitive moving average, which was the 5-day, and then I sold out on the less sensitive 12-day when it broke below that. And so here you see you would have taken your entry, let's say you would have caught a price of 82.18, you would have wrote it up, and you would have sold out, so you get about 82.90, right? So this is sort of a really good scalping strategy, day trading strategy. You can do these over longer periods of time if you change the time frame. Right now this is on the 1 minute, and the market is still open. So things are still moving, but you could certainly still look at these moving averages on the 5 minute or the 30 minutes or the 1 hour if you are looking to swing trade. So we can look at that in a minute as well. So that's one idea. You have two lines. One is to plot your entry. One is to plot your exit. If you think about, what it would have looked like if you had done the opposite, meaning take your entry off the orange and then take your exit off the green. If we're looking around the same time frame here, this one broke above the orange and held. Okay, so you would have had your entry here at about 82.19. And then you're looking for it to break and hold below the green, which it doesn't do that here. It's holding the green. And finally here, so it doesn't give you that much different of a trade in this instance. But the 5 and the 12 aren't that dissimilar. So let's say you went from 82.20 to about 82.90. That would be another opportunity for you to play the price action and catch it based on one of these moving averages and selling out based on the other moving average. Just keep in mind, if you're taking the entry point on the more sensitive time frame, so in this case, the MA5, and selling out on the less sensitive time frame, in this case, the MA12, that is what I called before a more aggressive stance because you're taking an entry point on the very sensitive time frame. So you're jumping into the trade just as it sort of may have moved a little bit, but that would have thrown the price action above that MA. But then you're waiting for it to come back down to an MA with more lag, meaning it's taking more days into account and therefore it's moving slower. And so there can develop, as this big run-up happened, you see how close the green maintained itself to the price action, but you see here before the run-up started, the green and the orange were very, very close to each other, but they start to spread apart as it goes up because the orange isn't moving as quickly with the price action. And so this gives you more space for the stock to come down a little bit and then jump back up. So let me see if there's an example of where that would have really benefited you if you had done it that way. There's not a great example here. Okay, I guess here's one. So if you had taken an entry here based on the price establishing above the green moving average, and then say you were going to sell out when the price went below the green moving average, you would have sold out here. This doesn't end up to be because these are also below the orange. See, what I was looking for was somewhere where the price would have been above the green and then dipped below the green but stayed above the orange, because that shows that you're having basically a more aggressive cut loss, if you will. Because you start to look at this like the green is your entry point, and then the orange is essentially your cut loss, or your take profit is ideally what you're actually looking for, is that it's a take profit. But just keep in mind, that if you take the entry on the more sensitive time frame and then use your take profit or your cut loss as the slower time frame, the less sensitive time frame, that will leave you a little bit more wiggle room in case the stock price were to dip below like this and then come back up. So that's what I was like looking for it to potentially do, was like if it had broke above the green and continued up, but then if it had come down, let's say it had come down to here, if you were taking your profit when it dipped below the green, then you would have sold out there. But let's say it bounced from here and continued up this way. You're still above the orange, so you're still in the trade. So that's why it leaves you a little bit more open to taking a bigger loss after the stock reaches its highest point. But it also gives you some wiggle room if the stock does bounce back and forth a little bit and you don't want to take an early exit. Let's adjust these out a little bit. Let's say we were trading off of the 5 and the 50. This should give us essentially the thing that I just talked about. So if we were taking an entry on the 5 and then not selling out until the 50, That's a pretty aggressive trade. Again, because you're buying in at the most sensitive point, so basically as soon as possible. And then you're selling out at a much less sensitive point, so you're giving yourself a lot of wiggle room in order to let the stock bounce. Let's go back here a bit and see what the price action might have looked like. Yeah, there's not an excellent example of the thing that I was just describing, where it would have like allowed you to stay in the trade longer without selling out. Because here, that's what's happening in this area, but then it ends up falling below the yellow anyway. So this is where this sort of more aggressive approach, this is why I say aggressive, because it can cost you money sometimes. So if you took your entry when it broke over the green here, and then you decided that your cut loss or your take profit was going to be at the yellow, you wouldn't have sold out until like this point here. But if you were taking your cut loss or your take profit when it dipped below the green, you would have sold out way up here, which would have given you a much better price at which to take your profit. So hopefully that makes sense. If it doesn't, just ask questions down below, and I'll do my best to try to re-explain it. So those are ways to take more or less aggressive trades. Again, if you wanted to take something less aggressive, what you could do is take your entry point as it moves above the yellow moving average, the 50-day. And so that maybe you would have done here. And then you are going to sell out as it dips below the 5, though I mean, it's such a small time frame, you probably wouldn't exactly set it up that way. You'd probably do something like the 50, and then maybe at least the 12. But let's just change this to a different color. Let's do a purple here. Say the 50 and the 20. So I want to buy in when it's over the 50, and then I'm going to sell out when it's under the 20. Like here, it would have just basically netted you 0, probably, for all intents and purposes. But it's a very conservative approach versus the other one, which is more aggressive, but does allow you to catch more of an upside. Whereas instead of like just continuously getting yourself immediately stopped out like you would here. The other thing that you can look at with the indicators is you can see if the stock in the long run, if you will, is in an uptrend or if it's in a downtrend. And so one simple way to do that is to just look at the 180 or the 200. A lot of people like to use the 200. It's just going to be, again, a little bit less reactive to the current price action. But this would essentially show me that, okay, this 1 minute chart right now, we're in a very bullish zone. So we are holding above our 180 SMA, and then as we come down to approach it, then we know if we dip below and we can't hold it, that then we're going to start putting in some bearish movements and potentially getting into a bearish area. As you see, the price will often bounce off of the moving average areas and try to hold them, and then once it dips below, then it'll become resistance. And so when it breaks, that might be a good entry point in order to ride the price strength up. And that might be where you say, okay, so if it breaks my 180, I'm going to take an entry point, and then I'm going to throw in my 12, and I'm going to use my 12 as my take profit or my stop loss. So I would have jumped in here, and if it's my 12, I would have sold out here. If it's not my 12, but my 5, so this one's going to be a more, give you much more opportunity. You would have bought in here, and then actually you get stopped out here, but so it's slightly better than the 12 option. But the other thing that you could consider is throwing up like a wide spread of moving averages. So the 5 and the 180 quite a big spread there, meaning it's not just the 5 and the 12, which are very close to each other. The 5 and the 180, two extremes essentially. And you can say, okay, I'm going to set a trading strategy of when the 5 crosses over the 180, I'm going to take a position. And so you see that playing out here. So you would have seen the 5 cross over the 180. You could have said, okay, I'm going to take my position, and then I'm going to sell out. This is sort of the question, when do you want to sell out? You could throw in, maybe something that feels mid-range-ish, like the 50, and say, okay, when my green MA5 crosses over the 50, I'm going to use that as my cut loss or my take profit. So you would have bought in here as the green crossed over the red, and you would have held it because you're waiting for it to dip below the yellow. So as the yellow is coming up here, the green's coming down, and they collide right there. And you would have said, okay, that's my plan, and I'm going to stick to my plan. And so I'm going to take my profit right there. And so this would have yielded you the best results of what we've been looking at, which would essentially be, say you got an 81.93 entry, and then maybe you got an 82.77 exit. Just based on the crossovers alone. So for me, when I'm just looking at MAs, that to me is one of the best strategies. Play it based off of the crossovers. And I would have set it up basically exactly like this. When the green crosses over the red, I'm going to take my position, and then I'm going to wait until it crosses down through the yellow in order to take my profit or cut my losses. I'm going to see if there's any place where this would have gone kind of astray. No, here it still would have yielded you a profit. Certainly there will be examples as we scroll back through the days, but I don't want to bore you by just... Okay, so here's an example. My green would have crossed over my red. And so you would have taken a position, right about here. I gotta stop doing this. Right about here. And then you would have waited for your green to cross off your yellow in order to cut your loss or take your profit, which here you would have bought in, say maybe around 81.65, and then you would have been stopped out at about 81.60. So it gives you a nice conservative approach potentially, on this sort of a play where you didn't lose a ton. But you would have had, I guess, bigger losses if you had done the exact same thing up here, for example, when the green crossed over the red here at 81.69. And then if you hadn't sold out until it crossed over here, which it just barely touched it. But if you were holding hard and fast to your rule, you would have sold out there, maybe gotten out at 81.58. So you would have lost about 10 or 11 cents a share, something like that. So hopefully that helps this last bit that we're talking about, which is not just having one or two MAs up there to give you trading plans to play off of. This last bit with the 3 is actually how I tend to set it up. But again, because it can get so loud on the chart, what I typically do is I leave the yellow off until I take a position. So if this was today and I'm waiting and I see, oh, green's coming. Okay, it crossed over. I'm going to take my position. So I go ahead, execute my trade, right around this area here. And then what I would typically do is I would come up, hit this, and I would turn off my red. So it's not even there. Turn on my yellow. And then, I can't see the crossover here, but I know that I would have taken a position here. And then I would wait for the crossover to happen. And it does right here. And so I would have then taken my profit there. So I would have had a trade from about 81.47 to about 81.77. So that's how I'd play it on the 1 minute. If you expand it out onto something like the 5 minute, this can give you more opportunities to trade off of because it lengthens out your period of time. So, you could run a similar style there that feels less scalpy, meaning you're not just potentially going for pennies. but you are having some bigger runs to play off of. So trying to see if there's any good examples here. We have all these boxes on here now. So let's get rid of these, and then let's just take a gander. So, okay, so this morning, if you had taken an entry on the 5 minute here, the only thing is you gotta like just be patient enough to be watching the 5 minute, because I know a lot of people try to watch the 5 minute and then they're like, I know that there's a 1 minute and I can see what's happening more granularly within that 5 minutes, and so they'll keep flipping over to the 1 minute. So if you're patient enough to play the 5 minute, there it came through, and say you got an entry point around 81.63. You came up here and you said, okay, let me toss out the red, get the yellow in there, and then we're waiting for like a break and a hold. So you probably would have held through here. What do we want to say? I mean, it broke and then it truly held here. So if you were going very like letter of the law with your rules and you're waiting for something to hold, this wouldn't have triggered it, though you would have been watching very closely. Same thing here. So anytime it dipped below, you'd have been watching it very closely. But the first one that really held, see, this one doesn't count because the green hadn't crossed over the yellow yet. So remember, the first trigger is the green has to cross below the yellow. And then you're looking at your sellout point. So which you could be immediate, or you could be the first candle that holds beyond that. It's sort of like your prerogative, but set the rule and stick to it. That's the point. So anyway, what do we say? 81.63, and then maybe you would have sold it out around 82.20. So that gives you a solid, say, 60 cents or so per share, and it played out over a much lengthier period of time. So this is where it's it can be a helpful strategy, but in an ideal world, you probably would have wished that you would have sold out something here in order to take advantage of that extra like almost $1 per share that you let go because you let it slip all the way down there. And again, just to be super clear on this, or try to be super clear, if you wanted to have an approach that gave you less wiggle room, so maybe it stops you out faster, but it also potentially allows you to ride a wave up and hold it for longer, you could have switched this to the orange. See, the problem is, if you're going for when the green crosses over the orange, you would have been stopped out here. And then, you wouldn't have been able to ride it all the way up here and then sell out here, because you would have been stopped out here. You would have been stopped out again here. So, it wouldn't have been until this big run up anyway that you would have really caught much of a profit. So the profit that we just plotted would have turned out better for you than this alternative with the MA5 and the MA12. All right, hopefully I didn't just confuse you terribly and that some of this was helpful. Drop questions below if you have them, and I'll do my best to answer them. I typically just read comments on the weekend and do my best to answer them then. But, good luck with your trading and as you try different things out. And, just realize that you might try out using the moving average indicator and realize that it just doesn't jive well with like your overall strategy or the speed at which you like to trade, or, it just doesn't give you enough wiggle room. It's too rigid. But it is good to develop rules and strategies for yourself to stick to so that you don't keep bending your rules and then getting yourself into troublesome situations. So this is something that helps protect against that and helps protect profits, even if they're little profits, so that you can grow your account over time. All right. Well, I hope that this was helpful, and thanks for watching. Feel free to share these videos, and I will see you in the next one.